Now, without any further delay, let's begin today's event. Again, key changes you need to know about for 2018. I would like to introduce your moderator for today, and that is Gary Bossert. Gary, you have the floor.
Great. Thank you, Alicia. And good morning and Happy New Year to everybody on the call. I am Gary Bossert. I'm the Vice President of Operations with the North Carolina Medical Society Employee Benefit Plan. I'm pleased to welcome you to another NCMS Plan webinar in our Employment Law Series. This series began last year in partnership with the law firm Nelson Mullins Riley & Scarborough. Since then, we have offered quarterly sessions like this for our practices to learn about important employment issues, not necessarily related directly to health insurance. Today, as Alicia mentioned, we will kick off the new year with a presentation entitled Key Benefits Changes You Need to Know About for 2018. As always, our presenter is Ann Murray. Ann is a partner in Nelson Mullins' Atlanta office. She has spent over 25 years advising employers regarding executive compensation and employee benefits. She previously served as in-house counsel for a publicly traded company and offers business-oriented and practical guidance to employers. Ann is a member of the firm's healthcare team, which focuses on providing comprehensive services to hospitals, physician practices, and other healthcare providers, as well as others in the healthcare industry. Thank you, Ann, for the great information I know you have to share. We will open up to questions following Ann's presentation. Ann, the floor is yours.
Thank you, Gary. And hi, everyone. I'm hoping that you're having a great Happy New Year so far. At this point, we're all sitting here in the benefits and HR side of the world trying to figure out what the impact of some of the recent tax law changes is on our business and our relationship with our employees. So that's going to be a big focus of what I talk about today. For those of you who maybe have not been paying attention to the news lately, we did have tax legislation passed on December 22nd, just before Christmas holidays, and that took effect on January 1st of 2018. Now, that's really unusual for big tax legislation because the fact is that, the tax code, if you haven't noticed, can be a little complicated, and things don't always work out the way that the original legislators intended. So the normal way that we see tax legislation passed is that, we would have some sort of legislation issued months in advance that is supposed to, take effect, give people time to sort of digest what's in place, allow people to point out mistakes that might appear in there or inconsistencies, and give the government the opportunity to issue some additional guidance, sort of answer people's questions on how is this supposed to work. So what you're going to hear me talk about today is, what we know from the couple lines on each subject that were in the tax legislation, and some of the open questions for us as employers with how we're supposed to implement these changes. There were also several IRS year-end announcements, and as always, a few Department of Labor issued rules that came out at the end of 2017 that you need to be aware about. So we'll talk about all of these, beginning first with group health coverage. Now, I know that many people had hoped that their duties as employers to comply with the employer mandate would somehow be going away as part of this tax legislation. The tax legislation did impact Affordable Care Act obligations, but for you as an employer, it didn't really do much of anything. What the tax legislation did was reduced the individual mandate penalty to zero. The point is, it would take too many approvals for the government to actually repeal the individual mandate. So what they do is, or what they did, is they worked within the powers that they had to simply reduce the penalty to zero. So technically, the way the law currently reads is you as an individual still have to have minimum essential coverage in place each year, and you still have to report it on your tax return. It's just that if you report that you didn't do it, your penalty is reduced to zero. So what does that do for you as an employer? Well, first off, you still have an obligation to comply with the employer mandate. So that means you still, if you have 50 or more full-time equivalents in 2017, have to comply with the employer mandate in 2018. So for anyone who's close to that cutoff, make sure that you've gone back and talked with your broker or any of your other consultants and confirmed, are you subject to the mandate for 2018? If you use outside staffing agencies, remember that depending on your relationship and what type of work those staffed workers perform for you, they may be considered your employees and may count towards that 50 full-time equivalent threshold. And also remember that we're talking full-time equivalents. So you could have 35 full-time employees and still hit that 50 full-time equivalent threshold if you have enough part-time workers who work enough hours. There's a whole calculation where you're going to total up the hours and divide by, a certain number. So if you haven't done that already and you're close to that threshold, make sure that you confirm. And for those that are subject to the mandate, your penalty potential for 2018 is going to be $2,320 per full-time employee if you fail to offer coverage to at least 95% of your full-time employees. And it's going to be $3,480 per full-time employee who purchases coverage in the exchange if you fail to offer affordable minimum value coverage to your full-time employees. And affordability this year is going to be 9.56% of your employees' household income, and you can use the safe harbor of Box 1 wages to determine that, or several of the other poverty line safe harbors. All of those rules stay in effect. What's interesting is, while I say that the employer mandate really hasn't been impacted, the fact is, won't it be impacted? Because, and won't your health coverage be impacted? Because if there's no individual mandate, if you're some 23-year-old invincible, employee or individual, whether or not you have employment, are you going to go to the exchange and buy coverage when there's no penalty out there making you do it? For a lot of those younger, healthy folks, they're no longer going to go buy the coverage, which means for you as an employer, either one, your experience rating and experience rating of all the different employers buying coverage is going to start going up, which will make premiums go up. Yay, it's like we haven't dealt with that for the last decade, right? Or the other question is, since you don't have all these individuals with some penalty that's forcing them to go into the exchange and buy coverage, if you're an employer who is choosing to use or thinking about using the MEC approach to your Affordable Care Act compliance, meaning you just offer a lower level plan and, in a sense, roll the dice or take the chance that not many employees will go to the exchange, and hopefully you won't owe that $3,480 penalty. It sounds like your odds are getting a little bit better, because if no penalty is forcing someone to go buy that coverage, it may be more likely that you get off the hook. So, talk this through with your brokers and consultants about what you do with coverage. But, for most people, your best approach is still going to be making sure that you've got coverage in place for all of your full-time employees. Also note, late at the end of the, or actually at the beginning of 2018, the deadline for Affordable Care Act forms has been extended. This is actually a continuation of some extensions that they had issued in prior years. Basically, what you need to know is that for Affordable Care Act purposes, when you file those 1094 and 1095 forms, your transmittal form is not going to have to be submitted until March 2nd of 2018. The date that you have to deliver your 1095-Cs to all of your individual employees. I'm sorry, actually I got that backwards. Sorry. So many of these changes have come out recently that they're still fresh in our minds. Sorry, the 1095-C that you deliver to individuals is now due by March 2nd instead of January 31st. Gives you a little bit of extra time to fill those out. You still have to transmit the forms to the government by February 28th if you're filing on paper, or April 2nd if you're filing electronically. So just a note on the slides that you'll see, I just have the 1095 transmittal. It should say 1094 transmittal, so my apologies. You know, for those of you who on the Affordable Care Act, and then we'll get off this subject, but on the Affordable Care Act thought that the Trump administration statement that there wouldn't be any enforcement or discouraging enforcement would benefit you. The IRS has actually started to issue those penalty notices for the first year that the employer mandate took effect. So for 2015, the penalty notices just started going out in the middle of December. And we're starting to have a few clients that have been hit with them. I've got one client that just a week and a half ago got a notice, and they have 900 or so employees, and they got a notice for $1.9 million. That'll wake you up quickly. On the bright side, for them, they actually were in compliance. They just didn't know how to fill out the forms. But it's something to make sure that if you are a company or organization that's subject to the Affordable Care Act employer mandate, make sure you have alerted your folks who might be getting mail that any type of form, and it's called the Letter 226J, and that's actually at the top of the form. If an IRS notice comes in, that they need to forward it to you immediately or to whoever should be handling it, because you have a really tight 30-day turnaround to appeal, and as in my example of the employer with 900 employees that recently got the notice, it can be a painful amount. Okay, enough about the Affordable Care Act. Now let's talk about some of the other things that may be impacting you. Health coverage levels. As with every year, you have new limits that take effect. So remember that your high deductible health plan limits go up. HSAs have gone up just slightly to $3,450 and $6,900. Flexible spending account limits have gone up to $2,650. If you have built that number into your flexible spending account, your health flexible spending account, you may want to amend your document to reflect the new limit. If you don't have a built-in limit to your flexible spending account, make sure that your payroll system, any limits that you've built in there for deductions for health flexible spending accounts are adjusted. One of those beginning of the year things that a lot of people forget to do, and middle of the year or end of the year, you'll find out that you cut people off a little too early. Okay, other health and welfare coverage notes are just that there were some disability claims procedures that changed last year, and the new rules were supposed to take effect January 1st of 2018. They apply, or changes are needed, for anyone who has any type of plan that pays benefits if someone becomes disabled, where the disability is determined by you or someone on your behalf as plan administrator. In other words, if you say to someone, listen, if we determine that you have become disabled in our sole discretion or with our own experts, we will pay you, whether it's the short-term disability, long-term disability, or maybe even a distribution out of our 401k or a deferred comp plan. If that's the case, then you may need to make some changes to your claims procedures to comply with these new DOL regulations. The effective date has been delayed until April 1st of 2018, so you have a little more time. Just pull open if you have any type of deferred comp, short-term or long-term disability, or 401k that has disability triggers, and just make sure whether or not you need to make a change. If your only disability triggers are under insured coverages, this is not going to apply to you. You don't have to worry about these claims regulation or claims procedure changes if some third-party insurer determines whether a disability exists, or if you say disability exists anytime someone qualifies under Social Security. So just something, a heads up, not a huge change to make, but you do actually have to take some steps. Okay, let's talk about fringe benefits. There were actually quite a few fringe benefit changes that were buried in this new tax legislation. And I think for a lot of people and for a lot of folks, you know, writing alerts and distributing all sorts of news articles, some of these have just sort of gone under the radar. Let's focus first on transit, parking, bicycling, bus passes, all of those sorts of things. You know, for years there's been this focus on encouraging folks to offer these types of benefits to their employees. We have a couple of conflicting changes to the tax rules that govern these types of fringe benefits. So first, parking and bus passes. Under prior guidance, if you provided employer-paid parking or bus passes, you could deduct that cost as an employer, and it was not taxable to your employees. That has now changed. You lose your tax deduction. However, it's still not taxable to employees. So it's kind of a weird mix there. Some people argue that since the corporate tax rate has now reduced to 21%, you know, maybe that loss of a deduction is not such a big deal. And maybe for employee relations purposes, you still want to make sure that you provide those benefits. But it's just something that you certainly want to think about. And taking sort of the tax analysis to another level, you'll see on the slide in front of you that this change in the law brings up some unusual questions. You know, what if you have a lease, an office lease, that includes employee parking spaces? So part of your lease payment, arguably, is for those spaces that you provide to your employees. Does this make part of your lease payment not deductible? Honestly, I don't know the answer to that. Like I said, you know, there's been so little time for this legislation to be analyzed that we don't have guidance yet. But it does just bring up interesting questions as far as that's concerned. Note, from the bus pass and parking perspective, employees can still pay for those things on a pre-tax basis, in which case they would not be taxed on it, and to the extent that you had paid them compensation that they used for that purpose, that would be deductible. So some experts are saying, hey, if you still want to do this and provide bus passes or parking to your employees, maybe you're better off giving them additional compensation and letting them pay pre-tax out of their pay. Then you would get a compensation deduction, and they would get things on a non-taxable, you know, continue to get those benefits on a non-taxable basis, and everyone would win. So that's something to think about and talk with your advisors on, but you know, it depends on the level of participation you currently have. Bicycle commuting was treated exactly the opposite way when they made the changes. So previously, prior to 2018, bicycle commuting reimbursements or payments were not taxable to the employee and were deductible by the employer. The tax legislation now says that bicycle commuting reimbursements or payments are taxable to the employee. However, you as the employer continue to get a tax deduction for making those payments. So it's just a little bit of a bizarre treatment there. This special rule expires in 2026, and you don't actually have to undertake any type of wage withholding for these commuting payments. But, you know, in both of these cases, you need to, if you are offering these types of benefits, first off, determine whether you're offering the benefits. Second, make sure that you update your payroll system so that the proper taxation is being applied. Third, make sure if you have a handbook or policies that you've distributed that those are updated so that people are being provided accurate information. And if you are a tax-exempt employer, similar to the office lease issue that I brought up earlier in this discussion, there's also a question on whether or not continuing to provide these benefits that are, you know, not deductible and that are will create UBIT, unrelated business income taxation consequences to you. So, you know, there's a lot of open questions. You should talk with your accountants and tax professionals to determine whether or not there are UBIT issues created in your case if you're tax exempt. The other fringe benefits that have now been impacted are moving expenses. Now, no matter how you handle those moving expenses, whether you do them as a reimbursement to the employee or you directly pay those moving expenses, in both cases, reimbursements are now taxable to the employee, and the employer deduction for direct payments has gone away. So if you have moving expense policies, if you participate in a program, especially through a third party that might be administering it, you need to make sure that you reach out and make any changes that are needed and determine, you know, how this needs to be reflected. Your payroll system may have some codes that need to be updated. And once again, as with all of these, if you're a tax-exempt employer, you may have some UBIT consequences depending on how all of this sort of pans out. Employee meal expenses is another unusual treatment. So if you were an employer who provided, let's say, on-site meals for your employees, we're not talking about business-related meal reimbursements. I mean, those still exist. So, you know, if someone takes a business contact out to lunch, you know, you can still pay for those, and those are, from a employee perspective, still tax deductible. We're talking about employer-provided meals. So that deduction is gone. However, there's now a new expansion of the 50% business-related food and beverage deduction to cover meals that you provide through an eating facility on your premises that satisfies sort of the tax de minimis requirements. So it's important, if you provide employer-provided meals or if you have on-site eating facilities, that you reach out to your consultants and advisors to make sure that, you know, to the extent you need to make changes, to ensure that you're getting the tax deductions and keeping those non-taxable to employees. On-site gyms are no longer deductible by employers, but similar to what we were talking about earlier with some of the commuting expenses, they're still not taxable to employees. So depending on the cost to you as the employer and the employee relations benefits that you get out of offering an on-site gym, it may or may not be worth keeping in place. Employee Achievement Awards, I don't know who had this on their special list, but apparently they felt the need to increase the deduction for personal property awarded if it's made under a written plan. So if you give Employee Achievement Awards, that are in kind, meaning, if it's some sort of, they get the watch, they get the some sort of personal property, make sure, if you don't already have it in place, that you memorialize it in some sort of written plan. I would expect that that can be done with a signed policy that is approved. It doesn't have to be some voluminous or expensive document, but that will ensure that you continue to get a deduction for those costs. Okay, retirement plans. So we're talking about qualified retirement plans here, and in particular, we're talking about mostly 401k plans. There really wasn't much in the new tax legislation that impacts retirement plans. However, for some of you who may have had folks that were impacted by the some of the 2016 disasters, they offered delayed taxation and relief from what would have been the 10% early withdrawal penalty for those unfortunate folks who were impacted by 2016 national disasters and who maybe had to take an early distribution from the 401k plan to try and cover some of their costs. If you have folks who may have been impacted or you were impacted, just know that that is a possibility. You can retroactively amend your plan to allow those types of distributions and to delay the taxation. I'm expecting not too many folks are going to find that helpful with the current audience, but just so you know. In addition, for years, when employees terminate employment, if you offer loans through your 401k plan, the typical approach is that when someone terminates employment, their loan is going to be defaulted. And if they don't immediately repay it, they're going to have to, it's going to be treated as a distribution to them from the plan. And it'll be subject to taxation and subject to early withdrawal penalties, so an extra 10%. One of the solutions that employees had was that they could actually roll over their loan to an IRA or another plan if they did it within the normal 60-day loan rollover period of time. But the problem is that's an unusual situation. Well, it's pretty common, but unusual in the sense of it's difficult for employees to try and find IRA providers or new employers and get all the paperwork done so that they can process this loan rollover. So for a lot of employees who should be saving this money towards retirement, instead it was being deemed distributed to them, and at a time when they didn't have a job or were in transition, they were being taxed and penalized on the money. Didn't make a lot of sense, and this was something that folks have hoped would be addressed for several years now. So the new rules say that if an employee terminates employment with an outstanding loan, that the employee has until his or her due date for his or her personal income tax return, including extensions, to do that loan rollover. So that should give, a number of months for someone to find the new job and be able to hopefully roll over their money. Now, with that in mind, what does that really do for you as an employer? It may mean that you do not necessarily want to default your loans immediately upon termination of employment. It may be worthwhile, if you have a lot of employees that could fall into this situation, for you to offer to allow them to pay, not through payroll, but rather by providing checks to whoever is administering your loan program. You also may want to think about whether or not you offer the ability for employees to roll loans into your plan. If you are trying to attract employees, think about the nursing side of things where it is so difficult to attract and get folks to move over from other employers. It may be worthwhile for you to offer to accept loan rollovers. Now, if you're thinking about doing that, you really need to talk to your retirement plan provider to make sure that they can handle or are maybe willing to handle those types of loan rollovers and what would be involved with it. But it, you know, in this day and age where it's harder and harder to get qualified applicants, especially in the healthcare side, you know, it may be an added recruitment benefit that you can offer. Many people had hoped that there were going to be some changes to the hardship rules. These had been proposed in the House bill, and there was a lot of talk about that, but just so you know, in the end, the legislation did not have anything that changed hardship distribution rules. Okay. Annual adjustments have been made, as they are every year, to your retirement plan limits. So for anyone that's not up to speed on how those have changed for 2018, in particular, just note elective deferrals to a 401k or a 403b on a pre-tax basis or Roth are limited to $18,500 per year. The catch-up is still the same at $6,000. So if someone is age 50 or older, their combined elective deferrals and catch-up contributions would be $24,500. So if you have not updated your payroll system, if you have one of those antiquated or more manual payroll systems, this is something that every year I have a handful of employers who discover that they don't have the right limits put into their payroll system or haven't updated them in years, and so as a result have not maybe deducted as much as an employee wanted to have deducted from his or her pay. The risk to you as an employer is if you don't keep up your payroll system limits, you could find that you have to contribute a portion of that money on the employee's behalf. So that's the standard correction method when you make this type of mistake. So it's worthwhile to make sure that your payroll system is updated. And also note that the compensation limit has gone up. It was $270,000 and it's now $275,000, meaning that your 401k or 403b can only consider the first $275,000 of someone's compensation when you're applying their elective deferrals and calculating their matches. So look at your population that might be over those limits, especially if you have a lot of doctors employed, and make sure that your payroll system has been updated. Also make sure that they're aware that those limits have gone up. Okay, leave programs. The tax legislation that came out actually gives a new federal tax credit if you provide at least 2 weeks of paid family leave and you pay the employee at a rate of at least 50% of their regular wages. Unfortunately, we don't have a lot of guidance on whether there are going to be more detailed requirements that apply to qualify for this federal tax credit. But in particular, you know, if you have an existing program that you think is close to qualifying, you know, investigate this federal tax credit. It may be worthwhile if you've thought about putting in place some type of leave program for a while and just haven't pulled the trigger. Maybe now's the time. The sooner you put something in place, the larger your tax credit will certainly be. So if you are going to go down this road, make sure you review and update your policies. You need to have everything consistent, and you'll need to make sure that you're providing required notices to employees so that they can take advantage of the new leave policies and so that you qualify for the tax credit. Okay, internship programs. As we move towards, you know, the standard summer internships, but also if you have regular school year interns that you bring in, note this has nothing to do with the tax legislation, but there has actually been a change in approach by the Department of Labor of how it classifies interns. So on January 5th of this year, so just, what are we on, the 11th now? We're not too far away. So just last week, the Department of Labor announced that it will use what they call the primary beneficiary test. This is instead of what used to be, they used to apply this stringent 6-factor test to figure out if an individual was a non-employee intern rather than an employee who needed to be covered under the Fair Labor Standards Act and needed to be provided minimum wage and overtime and all the things that the FLSA involves. If you can qualify someone as a non-employee intern, then unpaid internships are a possibility, and you don't need to comply with the FLSA and several other laws. So now there's a non-exhaustive list of factors that the Department of Labor will consider in determining if an intern is or isn't an employee. No one factor is determinative, but they're going to look, was there some expectation of compensation? You're going to want to make sure that if you are bringing in unpaid interns, it is 100% clear that this is unpaid. There's no compensation. Is there training that's more similar to what you would get in a classroom or educational setting or clinical or hands-on type of training rather than what you would give to an employee? Is this something that's closely connected to whatever the intern's education program is? Are there academic credits that you're giving? Is it related to whatever their degree program is? Are you letting them off, let's say it's during the school year, are you accommodating any of their needs for the academic calendar? Maybe they get off time when school is not in session. Maybe they're only working when, when classes are not, when they don't have classes. Is the duration limited to a semester or, let's say, a summer break? And then finally, the last two, is this something that you're replacing some paid worker? We don't want to see it. The Department of Labor does not want to see some sort of abusive situation where you get rid of a paid worker and now you bring in 1 or 2 unpaid interns to do the same job. That's certainly going to be a factor that would be against you. And then finally, are you holding this out as some means to get a paid job at the end of the internship? If so, that's going to look more like an employment situation than an internship, non-employee internship. So something to think about if you have interns or if you're thinking about going down that route. You want to make sure that, if you want to do it on an unpaid basis, you're going to want to make sure you revisit these factors and get some comfort that you're complying. Okay, back to the tax legislation. I know you see the slide in front of you and you wouldn't think that this was tax legislation, but given all of the recent press, whether it be Hollywood or anywhere else with sexual harassment and sexual abuse claims and all the settlements that are out there that, have not been publicized, the way that Congress decided to approach this was to put it in the tax legislation. If you provide a settlement payment to an employee, and it is possible that that employee may have a sexual harassment or sexual abuse claim, your settlement will be non-deductible if you have any type of confidentiality provision in your settlement agreement or release, meaning you require that the employee, or now former employee, not disclose the terms of the settlement. So this is not necessarily an area, we've been talking about this on the employment side with some of our clients, and there's no right answer here. Depending on the situation, at first a lot of people thought, okay, we need to revise all of our releases to just, exclude sexual harassment or sexual abuse claims from the release. Now that's not what we're saying here. This is just saying you don't get a deduction if it's subject to a non-disclosure agreement. Does that mean that you need to say anytime I settle a sexual harassment or abuse claim that I can't have a confidentiality provision? No, it's going to be a question for you as an employer. You're going to have to decide how valuable is that tax deduction. If the tax deduction is valuable to you, then you're not going to be able to have a non-disclosure or confidentiality provision in there, or you're not going to be able to have the settlement payment resolve sexual harassment or sexual abuse. If you don't care about the tax deduction, if this is a big enough deal that the publicity and exposure alone is something that you wouldn't want, well then maybe it's worth losing the tax deduction, and you can continue to use the same form and the same general release that you have for years. So just something that you're going to want to think about and talk through from the HR side and with your legal counsel to make sure that that you're taking a conscientious and deliberate approach in how you handle these settlements. Let me try and get this to switch to the next slide. There we go. Okay, those of you who are tax-exempt organizations, this is an important slide and important information for you. One of the big focuses of the tax legislation was on tax-exempt orgs. There are two provisions that you need to make sure you're not violating. First, if you are paying remuneration, and we're talking, when I say you, I'm counting both your organization and any other related organizations. For some of you, you may have divided up the comp being paid to maybe a certain individual that's at the top of your organization, and maybe they're getting comp from various tax-exempt orgs. If they're all related, the remuneration is going to be combined. So if the remuneration per year to your is $1 million or more, to any employee or former employee who has been in the 5 highest paid employees in any prior year. So in other words, once you become one of the 5 highest paid employees, forevermore you are treated as one of the covered individuals for purposes of this penalty. So a 21% excise tax is owed if you pay remuneration in excess of $1 million to any individual, employee, or former employee who has ever been among your 5 highest paid employees. So this is important to note. Also, before you start worrying too much about this provision, note there is a carve-out for compensation that you pay to licensed medical professionals if it's directly attributable to the performance of their medical services. So for a lot of the folks on this call, you might be paying some significant remuneration, both cash, profits distributions, anything of that nature that exceeds $1 million, but this carve-out where it's attributable to a licensed medical professional's performance of medical services may bring you down below that limit. So something to think about and work through if you have folks that are in this category. In particular, if you have related organizations, like I said earlier, that each pay the same person some type of fees, you need to visit that with your tax advisors or legal counsel and make sure that you're not going over that limit and incurring the tax. The 21% excise tax is tied to the corporate income tax rate, so it will continue to go up as corporate income taxes are adjusted. Also, for everyone who is a tax-exempt org, you are going to be limited to paying severance that doesn't exceed 3 times base compensation. If you go over that limit, then you will owe a 21% excise tax. That tax is also tied to the corporate rate, so it can go up. There is an exception for, once again, for licensed medical professionals to the extent that the payment is for the performance of medical services by that professional. But, you know, be careful and make sure that you are comfortable with that position if someone is a licensed medical professional. You may need to visit if you have separation or severance agreements or employment agreements that provide severance in place that might exceed this 3 times base. You know, make sure you go back through and identify what are your problematic arrangements and modify them as needed. Okay, finally, your deferred and equity compensation. This probably does not apply to too many folks on this call, but let me just at least run down these requirements so that you know what the new rules are. For private companies, you're going to hear about a new tax deferral opportunity. So private companies can issue stock options and restricted stock units under what they call broad-based employee plans. Now, when we say broad-based employee plans, we're talking about a plan that has to be offered to 80% or more of the employees in the company. That is, in my experience, almost unheard of to have that type of plan. Maybe if you're in Silicon Valley, but you know, not in the southeastern United States, and especially on the healthcare side. But there may be a rare circumstance where that's not the case. If you're a private company that offers options or restricted stock units in a broad-based employee plan, there's this new Code Section 83I election that basically can allow the employees to defer their taxes for up to 5 additional years after they settle or receive the underlying stock. So for those that can take advantage of it, I suppose it's a good thing, but honestly, I'm not quite sure why there was some big need to put this in place. For those who offer incentive stock options, once again, not as common on the healthcare in the healthcare industry, but if you do offer incentive stock options, note that there are decreases in the alternative minimum tax that may offer some savings for your employees. More likely, some of you may actually issue profits interest to some of your, if you are an LLC or a partnership or limited partnership, you may issue what we call compensatory profits interest, where you give someone a equity award that gives them a right to a portion of the profits in future years. The taxation of profits interest has changed. It used to be that you had to hold them for at least 2 years in order to get long-term capital gains on those interests. Now you have to hold them for at least 3. So for those that impacts, you know, take note. Public company, much less applicable to most of the folks here, but just know that you're going to hear this from a lot of folks. Public companies have lost their performance-based exception to the $1 million comp limit that applies to them. So there's going to be a lot of changes that you're going to hear about and that you're going to see where public companies may change the types of equity awards that they make, because many of their equity awards will no longer be exempt from the $1 million limit. Public company boards won't have to worry about the qualifications of some of their board members to serve on the comp committee. There's other reasons they may still have to worry about that, but for purposes of the performance-based exception, they also won't have to set performance targets within the first couple of months of a year. So there's going to be some changes you will see. This is a big deal in the public company realm. And then finally, the maximum tax withholding on equity compensation may need to be adjusted. So if you do offer, whether it's restricted stock or other equity incentives, if you have something built into your payroll system to take tax withholding at the highest tax bracket, remember that tax bracket has now come down, and so you need to go into your payroll system and adjust your rates so that you're in compliance. Okay, that is it for the tax legislation discussion, but what I really want to point out to everybody as we sort of wrap up today is, like I said at the beginning, what was unusual about some of the changes that came down at the end of 2017 is the lack of any time to digest them and sort of react and correct. What you can expect is over the next probably 30 to even 90 days that there's going to be a lot of additional guidance coming out from the IRS, the Department of Labor, and other governmental entities that relates to these changes, because folks are still just trying to figure out how they're going to work. And so stay tuned and make sure that if some of these things apply to you, that you've got somebody out there that's letting you know if additional guidance comes out, in particular on some of these fringe benefit changes, so that you can react. Okay,
great.
Gary?
Yeah, thank you, Ann. That was great information. I know I learned a lot just from listening. We're going to open it up to questions. If anybody has questions, you can type them into the Q&A window. We will have a copy of this presentation, a PDF, will be available for you to download shortly. Alicia will make that available to you, and then the full audio video recording will be made available on the Medical Society, the NCMS Plans YouTube channel, where this and all of our prior employment law webinars are saved and stored and available to you. So you can check that out there. That will probably be up, I would say, probably by Tuesday. You can find that on the YouTube channel. Also, while I have your attention, I want to just talk briefly about a new program that we're excited about at the Medical Society Plan, the Practice Wellness Grant Program. Many of you who have been in the plan for a number of years are already familiar with the grant program. It was something that we started a number of years ago. We have new funding for that grant program. It is intended to help practices start or enhance current health promotion programs in their practice. You can work with Jason Hooray, our Health Promotion Program Manager, to learn more about the grant program, what you have to do to earn dollars. The grants are up to $100 per enrolled employee, a maximum of $20,000 per practice. So I encourage you, if you are thinking about start kicking off 2018 with a health promotion program for your employees, talk to Jason Hooray, email him. You can certainly email me and I can connect you with Jason, but that would be a great way for you to start 2018. Let's see, lastly, oh, Ann, I do have a question. In our last webinar, we talked about the overtime rule, and in 2017, there was some discussion about whether there was going to be change to the overtime rule and whether the minimum salary threshold would be increased as to define exempt employees. Do you see that there's any change on the horizon in 2018 to the overtime rule? Will that be something that we'll continue to talk about?
Yeah, at this point, and I'm glad you brought that up because, yeah, I should have raised that in this discussion. We have not received any further indication that there's going to be changes with the overtime thresholds. It's still out there. I mean, the request for, input didn't go away. They're still digesting it. Some question whether or not the Trump administration's, influence of not issuing new regulations or for every regulation, taking back a few is impacting this. But at this point, your guess is as good as mine.
Fair enough. I appreciate it.
Yeah, unfortunately, we don't know. We don't have anything to go on.
Gotcha. All right. Well, I want to thank you, everybody, for participating. Thank you, Ann, for presenting. Look for another invitation for our next webinar. Probably will be sometime in April. So, again, you'll get an invitation for that. Thank you very much. Have a great day and a great 2018.
Thank you again for joining us. This does conclude today's conference. You may now disconnect.